Ladies and gentlemen, we're ready to begin. Before I introduce our guest, I'd also like to acknowledge that this is a special meeting of the Golub Center for Finance and Policy, not only because of all the people who are here, but because it's the 10th anniversary of the center. And so we owe congratulations especially to Ben and to Debbie, who have had the founding vision and have brought this group or similar groups together. Yes. And so I'd just like to lead with a thanks to them. So our guest speaker this evening is Adrienne Harris, who is the superintendent of the Department of Financial Services in New York. Her whole bio is in the program, so I encourage you to take a breath and read all of that. But we can say, just in summary, that Adrienne is a lawyer by practice or by preparation, and she practiced law and then served in the Treasury Department in the Obama administration, and then moved over to the White House to the National Economic Council, where she worked on financial services. She started her own firm, took it public, and then directed the Center of Financial Policy at the University of Michigan in the Public Policy School. So she has a range of experience in the private sector and in the public sector, and I think that's actually played a big role in her work. So I'm going to open by asking Adrienne to talk about how all of this background has played into her work at the Department of Financial Services, and also to tell us what happens at the New York Department of Financial Services, because we know that New York plays an outsized role in everything, but especially in financial services, and that any company that's doing business in financial services is regulated by your department because it has such a broad mandate. But if you go to California and talk about cryptocurrency and how that's being regulated, they'll say that the framework comes from what's happening in New York. So New York is a leader nationally and internationally. So what did you bring to the table, and how big is this table that you're working on?
Well, maybe I'll take those in reverse order, and thank you all for having me. It's really special to be here, especially on the 10th anniversary, so congratulations to the center. At DFS, we regulate about 3,000 financial institutions, so state-chartered banks and credit unions, including 15 GCFPs and 120 foreign banks. We also regulate several thousand insurance companies across health, life, and P&C. We're the only prudential regulator in the country with crypto-specific authority. We regulate mortgage, student lending, pharmacy benefit managers, money transmission, so sort of you name it, we regulate it. I also oversee the New York Liquidation Bureau, so when we have insurance companies that become insolvent, I oversee the Liquidation Bureau as well, where we have about $1 billion in assets under management there. So there's a lot to do. Thankfully, we have a wonderful team at DFS. As Jan mentioned, I've had a career. The only thing I know anything about is financial services. My whole career has been sort of public and private sector and financial services, starting at Sullivan and Cromwell in New York, working on financial regulatory matters before going to Treasury, NEC, and then starting my own fintech firm out in San Francisco after the Obama administration, taking it public, spending some time in academia at the University of Michigan, as well as sitting on a number of boards before coming back into public service when Governor Hochul asked me to take this role just about 3 years ago. And I think for me, that experience of having been in the public and private sectors and in academia, I hope makes me a better regulator, because we've compiled a similarly diverse team to help us surface all the best data, information, perspectives, and insights so that we can make very smart, actionable policy. And for me, being in the financial center of the world means it's a perfect proving ground to say in my view, there's really no room for ideology in financial regulation, and that we can protect consumers and markets while at the same time creating a thriving marketplace, and that those policy objectives should not be mutually exclusive, but in fact are mutually reinforcing. And so that's really what we strive to prove every day at DFS.
So a piece of what you just talked about, I think, is dramatically underappreciated in the public sector, and especially when people in the private sector look at the public sector, it's a huge management job, and trying to serve the public good from within the public sector. I mean, you have an enormous mandate, but you've also thought a lot about how to run the department.
Absolutely.
And so having had this broad experience, what did you bring?
Yeah, I mean, I really did leverage my time in the private sector to think about how do we make this place run efficiently and effectively. So one of the first things I did when I came into the department is we looked across our staffing. And we said, what are the institutions we regulate? What are the risks that they present? How many people do we have stacked up against them? And my favorite statistic that came out of that work was in New York, we have about 77% more domestic insurers than does California. But the California Department of Insurance had twice as many people as my insurance division, right? The math didn't math, as they say. So we went to the state legislature and the governor. We got the department fully funded for the first time in its history. And in my 3 years, we've hired over 500 people, including 100 new examiners, which is really the bread and butter of what we do, is to examine. We've made about 400 promotions, people who had been in the department decades and never really had their work and efforts recognized. We've remodeled a lot of the civil service titles to be more modern, and so that we had the cybersecurity experts and the crypto experts that we needed. And now we're in the midst of a $60 million 3-year technology transformation where we're really using a data warehouse and a CRM to do process mapping and to make sure we have data all in one place. We created a data governance unit to make sure all the data we were collecting from financial institutions was clean and had the proper access, so that we could really leverage that to make more insightful supervisory conclusions. So we've really done quite a lot of work. And then just recently, we've hired the first CTO in the department's history. And then we just hired the first chief risk officer in the department's history, so we could do our own internal audit and risk assessment. So it really has been quite an operational load. It's been incredibly gratifying with, it ranges from sort of these big projects like the $60 million technology transformation to little things. For instance, we have 60 peace officers on staff who do insurance fraud investigations. They all have state-issued vehicles and weapons, which in my mind is risk everywhere. And so we went back and said, well, what is our gun storage policy in the office, right? Like these really sort of simple things that you don't think about in the financial regulatory context, but were really important for how the department runs. So it's been a fun exercise to rebuild this institution while also doing the policy work.
So at the same time, you're building and fortifying the foundations of how the department works. But there are also new issues arising all the time, and you have to be prepared for those. So with cybersecurity is what I'm thinking of now, which is on, the forefront of concerns. You recently issued amendments to the cybersecurity regulations. So could you talk a little bit about, how you think about the regulator's role and the changes that you made?
Yeah, absolutely. So DFS was the first financial regulator really to come out with cybersecurity regulations in 2017. And those became the model for the Conference of State Banking Supervisors, for the NAIC, the National Association of Insurance Commissioners, for the SEC, right? You can really look across financial regulators and see that their cybersecurity rules came from the original DFS rules. But 2017 to 2024 in cybersecurity years might as well be 100 years. There are so many new risks that have come about in that short period of time. So we really felt like it was time to amend that regulation. So we did a number of things in the amendment. First, we took account for ransomware, which was not really part of the conversation in 2017, but of course is a huge part of the conversation now, especially as we oversee crypto. So there's an interesting overlap there in our supervisory responsibilities. We retailored the regulation because, as I mentioned, the diversity of institutions we oversee, crafting a rule that's fit for banking and insurance and crypto and insurance brokers that are two people on the one hand and, Goldman Sachs and AIG and MetLife on the other, right? Crafting a rule that can fit all these institutions and figuring out the tailoring for that was a big part of the amendments we made. And then we made a lot of adjustments to our governance requirements to say, all right, now it's 2024, cybersecurity is on everybody's mind, so there really has to be strict accountability on the executive and board level, and what does that look like? But then we spend a lot of time really thinking about all of the regulatory tools we have. So we have a great set of cybersecurity examiners that just do cyber exams in addition to all of our safety and soundness exams. And then just recently, we issued guidance around AI and cybersecurity. So we use guidance as a tool to really keep up with risks and new technologies and new trends. And so while that guidance didn't add new requirements to the reg, it sort of said, here's how you should think about the regulation in the context where AI is becoming more of a threat vector, right? So now we see social engineering attacks that are much more sophisticated because of AI. So here are some best practices that we think are useful in your defenses. And we also took the opportunity as part of that guidance to say to our regulated institutions, there are ways to use AI as part of your defenses as well. And here is our view as a regulator on how you might go about doing so. So I think it's been very impactful.
So since you bring up AI, so I was just at a conference where there were a lot of technologists who are very excited, very pro, want to see where this takes us and think it could be transformative. There's at least in this group, a smaller group that was raising questions about safety and other issues. So from a regulatory point of view, how do you balance and how do you think about something that potentially has this transformative process, but there's nagging concerns? Like you want to promote innovation,
right?
But you have a mandate also of protection.
Yeah, and also regulators as a people tend to be pretty risk averse and nervous all the time. Well, for AI, it's so big, right, and so fast moving, and I think it's very easy for people to say, oh, AI, and not really know what they're talking about. And so one of the things we've really done is to try and take small bites from a regulator perspective. So I mentioned the cybersecurity guidance that we did last week. Several months ago, we did some guidance on AI and insurance, but we limited it to underwriting and pricing. So rather than try to boil the ocean of what AI and insurance could mean and talk about claims and talk about customer service, we said, let's just limit this first bite to underwriting and pricing. Part of that was to say that standard frameworks around anti-discrimination remain true regardless of the type of technology you use. Just because you have new fancy AI doesn't mean these old frameworks fall away. And as part of that, we required testing from our institutions. So we said, you can use AI, right? It's got lots of benefits for efficiency, maybe for more precise underwriting, but we're going to require you to test the algorithms to make sure there isn't unfair discrimination baked into those algorithms. And of course, in that calculus, the unfairness part is key because insurance, after all, is a business about discrimination of risks. We said, the principles of third-party vendor management in financial services, of course, persist. So it's not going to be sufficient to say, well, we have a vendor that did the algorithm, right? And so therefore, it's not our responsibility as the regulated insurance company. You are responsible for the AI vendor the same way you're responsible for any number of vendors that you might use as a regulated financial institution. So that was another important part of that guidance. And on the testing, we really laid out those statistical methodologies that we thought were most useful. So we really tried to give good guidance to our regulated entities, but strike this balance between principles-based and something that's a little bit more prescriptive so that they really had good instruction there.
So just following up on the testing, I mean, this is required in any kind of algorithm and fintech. So how is it different requiring this in AI? Maybe they don't have the visibility into the algorithm. So you look at the results in a different way.
Look at the results, we make them test different variables to see if there are less discriminatory variables. And this was, it was an interesting thing because even where we are not required to do notice and comment on things, we do it anyway, because I'm a firm believer in engaging all of our stakeholders. So we put this guidance out for notice and comment. Largely what came back from industry was, there's no possible way we can test. It's too hard. It's too onerous. There's no way, right? That nobody understands the algorithm. Unfortunately for them, the company that I started and took public was an AI insurance company. And I said, no, actually you can test it. I know that because I've done it myself. And so we were then able to go back as part of that commentary and say, look, if you think this is a problem, here are the methodologies we think are acceptable. And here's the cadence in which we expect you to do this. And so I think we were able to bring my background and the background of the team, which is also quite diverse, to bear to make the guidance more actionable.
So in crypto, as I mentioned in the beginning, DFS has really been a leader in providing a framework and accountability for use of crypto. So maybe you could first talk about the way in which you've done that, and then the influence that it's had in other places that have been a little less forward-leaning.
Yeah. So DFS has been regulating crypto for about 10 years. So I inherited the regulatory framework. But then for us, the challenge was, how do you operationalize it? And of course, even the cryptoverse has changed quite a lot in 10 years. So the first thing I had to do was build a team. When I got to DFS, there were maybe 3 people in our crypto unit. There are now 60 people in the crypto unit. It's the largest crypto regulatory unit anywhere in the world. And we have people that come from federal regulators, from academia, from industry. It's really we have some real crypto bros on the team as well. So it really is quite a diverse group. So that was sort of thing one. The next thing was, how do we sort of update the reg, provide guidance, add some meat to the bones, given how the space has evolved. And so in my 3 years, we've issued 9 pieces of regulatory guidance related to crypto, around stablecoins, around market manipulation, customer service expectations, reserving requirements. So in New York, first you have to be licensed by DFS if you want to engage in what we call virtual currency business activity in New York. The licensing requirements are quite onerous. For instance, we did not license FTX, Voyager, Celsius. Any of those folks were not allowed to do business in New York. Then, of course, we examine you just like we do our banks and our insurance companies. And then where we need to, we bring enforcement action. So we brought a $100 million case against Coinbase for cybersecurity and BSA violations. Just earlier this year, we got $2.1 billion back to consumers from the Gemini Earn product as a result of some compliance failures there. So we've really leveraged everything from the rule to guidance to enforcement actions to regulate the space. And what we see now is New York has become the good housekeeping seal. So I have regulators from around the country and around the world say, we know if a company has passed New York's test, it's good for us. And as we look at frameworks out of the FCA in the UK or MiCA in the EU or what they've done in the UAE, you can see the influence of New York in all those frameworks, Illinois, California, and even we've been consulting on all the bills working their way through Congress for now the last 2 years. We remain optimistic that some of those will get across the finish line this year. But you hear everybody from Chairman McHenry to Sherrod Brown say this is based on what New York does, and we want to replicate that on the federal level. So I think it's really a testament to what the team has done in that space.
So we had a discussion today. We had a panel about climate, and insurance was a big issue, and one of the concerns is state level regulation, which has a long but not always vaunted history because of that heterogeneity. Yeah. So do you think in having states take the lead will have a happier ending in this case?
In the crypto?
Yeah.
Well, I will say probably nobody is more eager for a federal partner than New York, because we really do feel like we're kind of holding up the whole thing for the country. In part, the same cybersecurity requirements that apply to our banks and insurance companies apply to our crypto companies. The same BSA, AML requirements that apply to our banks apply to our crypto companies. And that's good for everybody, because it's not as if a company is going to have a cybersecurity program for New York and then lesser standards for the rest of its enterprise, right? It's sort of the rising tide lifts all boats. I think, interestingly, we hear this critique of race to the bottom when it comes to states. And of course, Florida really wanted to be the crypto capital. Like, there's no regulation here. Come to Florida. What we've seen is actually, to the contrary, despite the fact that New York has the most rigorous standards anywhere in the world, is that the plurality of investment in crypto, 40% in many recent years, is in New York regulated companies. And I think it's because investors, partners, right, especially as we think about traditional financial institutions, customers see that good housekeeping seal. And so it's really drawn investment to our regulated institutions, as opposed to those that are looking to evade regulation.
So we talked earlier, examples of crypto companies in New York. Just name a few.
So some of our licensed entities, which are all on our website, Coinbase, Paxos, Circle, are all licensed by us. But I think, importantly, once you get the license, it is not licensed to then run free, right? We have material change of business requirements. So if you want to offer a new token, you want to use a new protocol, you want to offer a new service, you were doing custody, now you want to do exchange, all of that requires pre-approval from DFS. So it really takes a lot to do business there. Similarly, we've issued guidance for our banking institutions. If they want to engage in virtual currency business activity, whether it's custody or payments, they also have to get pre-approval from us, and it's quite hard to do.
So, in addition, one of the topics at the forefront in the conference is new products. It's in the title, and innovation, and a discussion about retirement, climate, as I mentioned. So, are there areas? I mean, you see things before many of the rest of us do. I mean, we see needs that need to be filled. Innovation can certainly help with that. What innovations do you see coming down the pike?
Yeah, I think there's a lot of things. We've been talking with a lot of institutions about agentive AI, right? Like AI that doesn't just provide insights, but that can actually take action. And what is that going to mean for financial services? I'm quite excited about that, despite some of the risks that are clearly lurking. But I think that's going to be a really interesting space, especially as we think about personal finances, because you see so much of what happens in personal finance is just a little analysis paralysis on the part of consumers. So if you had an AI tool that could actually help them action decision making, I think that could be quite beneficial given the proper guardrails. We've been doing a lot, of course, on things that are not so new, but buy now, pay later, earned wage access, right? How do you regulate those? To what extent are they loans or not loans that depend on the business model? So really making sure we have a robust taxonomy for how those business models present, and in what cases are they loans or something else, and how do we write rules accordingly? And just because you mentioned climate, when I came in, I created a climate division because I needed something in the agency that could marry the climate risk we were seeing on the banking side with climate risk we see on the insurance side, and help us really draw good supervisory insights. So for instance, we're now engaged in a partnership with the State University of New York system, the SUNY system. They have some new supercomputers thanks to the governor's AI initiative. And we said, well, how do we look at insurance data, mortgage data, and then take this incredible treasure trove of weather data that SUNY has, weirdly, where it's like weather from every county in the state for every 5 minutes going back 40 years. How do we compile all this data and draw interesting insights about insurance risk and banking risk? And I think importantly, prevent climate redlining, because we know that LMI communities are disproportionately affected by climate change. How can we use all this data that we have that traditionally sort of lives in silos, bring it together and make sure that when we say to banks and insurance companies, you have to manage your climate risk, that doesn't mean we don't lend in Far Rockaway, right? Or we don't provide insurance to the LMI communities that need it. Yeah. So I'm excited about that, the supervisory use of some of these technologies as well.
Before we wrap up, there's a lot of discussion now about emerging financial technologies, and there's lots of meetings and sandboxes and discussion of fintechs and new courses being taught partially through the Golub Center on this. So we see more and more. Do you think that in that evolution, did we miss some things? Are there some places we could have, filled in, or new things we should be thinking about, before we get to AI and cyber? What are we missing in financial services?
Yeah, I mean, I think the interesting thing about fintech, if you rewind to 15 years ago when it was sort of a new term, you had all these fintech people who came in and they wanted to disintermediate all the institutions, right? And they would come when I was in the White House and say, like, Citibank isn't going to exist in 10 years. We'd be like, all right, relax. Like, Citibank's going to exist in 10 years, right? And it turns out that customer acquisition is hard, that compliance is hard, but there was also this promise of financial inclusion, right? And using technology to bring new people into the financial system. And I think what we've seen is that promise is yet unrealized, right? Even as we think about earned wage access and buy now, pay later, and some of the inclusiveness that does bring and flexibility that does bring, it's still the same people who are already in the financial system who are then the first adopters of those tools. And so I think there's still a lot of work to do on the inclusion front. And as I'm sure you all have talked about, right, things like digital ID, right? How does that help bring people in? How do you use technology to engender trust? Because when you survey people and say, why don't you have a bank account? It's not because they don't understand the benefit of having a bank account, or they don't understand that payday lenders and check cashers are predatory. It's trust, it's lag in payment times, it's all these other things. But tech and fintech have yet to sort of convince, I think, those consumers of some of the benefits that are to be had there. And I think the regulation hasn't quite caught up to allow for a more inclusive financial system. So still a lot of room to go there.
Sure. Last discussion. So let's zoom out, think big picture. From your chair, you see deeply, but you also see the new trends that are coming. Yeah. What should we be looking for down the road?
Yeah, I mean, as I noted earlier, I think the agentive AI stuff, we're still talking a lot about the Gen AI, but the agentive AI, I think is really going to be interesting. And I, when I was teaching, I would always give an example about, like, where is the app where I could put in my own personal financial goals, saving, investing, or whatever it was. And then when I went to, in my case, it's usually like an anthropology store for those who shop at Anthropologie, right? And then when I got close to an Anthropologie, my app would be like, do not go in there. You have these savings goals that will go right out the window as soon as you cross the threshold, right? So how do we leverage agentive AI and other technologies? It's a very personal example. Right, to help with that financial decision making, because I think we're going back to the inclusion discussion. We're still in a place where we think about financial education in a way that's very divorced from the time when a consumer is making a financial decision. We do this at DFS. We still sort of provide pamphlets about mortgage that are going to end up in a drawer somewhere far from the time when the person's actually making the decision about mortgage. So how do we use technology and I think agentive AI to help consumers make better decisions in the moment, or at least help highlight their options better? So I I'm optimistic about the app that's going to keep me from shopping too much and help me with my own financial goals and other people's as well. Yeah.
I don't know. I go back to trust, which I don't want to put all my financial information in that app. It's scary, right?
It's an interesting question, right? Because I think a lot of consumers would say, I just want the convenience of everything in one place. Where is the super app that does everything? And then there are consumers that say, no, I'd really rather have a specialized place, retirement, investing, savings. But I think ultimately what it comes down to is choice. And making sure people have those choices. There we go. Good.
All right. So those are all the questions I have. Any last parting comments? What did we miss?
No, none.
Any confessions? You were on the verge.
I have so many confessions, but with Nate over there, I don't want him to.
Okay.
No, I think, as I said at the top, I am a firm believer that really ideology has no place in financial regulation, and often gets me in trouble with some of my colleagues, especially in DC. But I think the more we can think about as a group of stakeholders engaged in the financial services space, how we continue to promote this idea that you really can protect consumers and markets and create a thriving marketplace. And these are not mutually exclusive goals. In fact, they are mutually reinforcing goals. I think that's going to be really important as the financial system continues to become more complex, as we invite more consumers into the space, as markets continue to grow and evolve. And so that for me is really sort of my motivating hypothesis.
Great. So thanks very much for joining us. Great to have you here.
That's good.